Well, good to see you, Mark. Are we good to go? I don't have my team queuing. Are we good to go? In the back? Good. Okay, great. Well, welcome everyone. Let me give you a disclaimer here. Actually, there are probably 3 disclaimers. First of all, if you came to this last year and saw me, you're going to hear much the same, just a little bit updated. I agreed to do this because it didn't take a lot of work, because I'm retired. And I serve on some boards, and I have the qualifications. My conditions for serving on the board are, number 1, I don't do homework. I'm not taking projects home. Don't give me deadlines. Don't expect me to complete work for you. I'll mentor, I'll come and I'll meet with you, but I don't do homework. Number 2 is if your board meeting interferes with my travel schedule, I won't be there, because that's why I retired, so that I could do that. And so part of this was an agreement to come back and kind of update a little bit about what we talked about last year, do a little bit more about it. First of all, for those who don't know me, my name is Kent Thomas. I was the original founder of Amplio. It was CFO Solutions in 1996, changed the name to Advanced CFO, and then after I left, they decided to get a cool name and call it Amplio. So anyway, these are just a few of some of the great companies that I had an opportunity to work with. How you doing?
Great. Good to hear from you.
This is a guy that goes way back. To the Skull Candy, right there, right, let's see, yeah, right there. Ron Ross right here. So those were good times. What we're going to talk about today is really developing internal partnerships to add more value to the organization. And I'm going to take it from the perspective of the CFO and how the CFO should be thinking and acting and functioning. So I have a list of items here, and I'd love you to just read through them quickly. Which of these finance initiatives add strategic value? So take a second and just read through those and answer in your mind yes or no. And then we'll go through them. Because sometimes we don't really think about what strategic value really is. Over the course of my years of being a CFO and running Advanced CFO and serving for some 85 different companies, people would frequently ask me, what's the difference between a controller and a CFO? And I had a one-word answer. It's strategy. CFO has to be focused on strategy. Controllers can be, in my experience, rarely are, but some are. But a CFO must focus on strategy. Everybody had a chance to review that? Let's just go through them one by one. Accurate financial statements issued by the 5th of the following month. Oh no, that is not strategic. That's that or better is just accepted. That's just to keep the lights on. Accounting and finance teams understands their duties and consistently function well. That is not strategic. This is part of a foundational process of having a team that gets things done and provides actually valuable information. Regular meetings with department heads to explain financial results. No, it's not strategic. It helps. It's better than some do, but it's not strategic. Offer to assist marketing and sales with a product pricing analysis assignment. Yes, now you're being strategic. You're taking your value, your abilities, and you're putting it into the organization and making a difference so that product pricing analysis, not just so that it's right, it doesn't mean they couldn't do it, but you're adding your insights and your support. And in the process, you are building a relationship. And at the end of the day, relationships are everything. They're everything in business. So at Advanced CFO at Amplio, we used to track every single new client, where it came from. There was a time in which 80% of all of our new clients came from referrals, from existing or prior clients. And that's all about relationships. Speaking of Skull Candy, Rick Alden would call me up 9:30, 10 o'clock, 10:30 at night. He'd have a great idea. His idea was usually about, oh, I've got this friend and he's saving taxes doing whatever it was. My response was not only no, hell no, That's illegal. We can't do that most of the time. The key, though, is that Rick Alden called me up to talk before making a decision. That's relationship. That's how you bring strategic value. Meet with and survey board members to evaluate current board reporting. Yes, strategic. What do they want to know? What do they need to know? We'll talk a little bit more about board members in the future. It's a key role for a CFO, and most of us don't recognize it. Let's go to the next one. Regularly analyze and report on competitive economic and industry trends. Yes. Yes, things that we should be thinking about and doing all the time. And search for, identify, and analyze important customer, product, productivity, and other trends. Project the impact and suggest actions. Yes. Now, I don't know about you, but I hated it when someone would come into my office and say, hey, Kent, we've got a problem. And they would tell me the problem, and then they would turn around and walk out. Don't come into my office and tell me about a problem. If you're going to tell me about the problem, what's the solution? What should we do? Come with an idea. It should never be just give me the problem. And that's a little bit about how we get into this whole area of strategy and managing people. But anyway, so with that as a background, I love this quote. This is from a large enterprise software company CEO as he responded to one of our surveys. Finance, while it doesn't actually own the strategy, is responsible for being the institutional memory of the company and offering a framework against which we can present our strategic choices of how we're going to develop as a company. Finance makes sure the right choices are framed up. I think that speaks very well to what you want to do as a CFO, what your goal is. I'm going to talk in terms of 4 key roles of a CFO. The financial partner to the C-suite, and notice that doesn't just say CEO, being the chief future officer of the company, the chief trust officer, and then your role as a board advisor. So that's what we'll talk about. By the way, this is not a lecture, so interrupt me, yell out, say something. I'm perfectly good with that. The strategic CFO, this financial advisor, first of all, this is a given. The dial tone is always on. I credit this to Dave Chase, but he's absolutely right. In your organization, in the company, the dial tone has to be on. Nobody should pick up the phone, go to the computer, look for a report, after information, and it's not working. It's not there. That's not okay under any circumstances. So regulatory compliance, you've got to be on top of that. This isn't strategic. This is just the basics. You've got to have a foundation that whatever your regulatory responsibilities are, you're on top of them. We were at lunch. This young man right here in the maroon shirt was talking about, he's got a sales tax consulting business. And we were talking about how many companies get started, they don't even know what nexus means, number one, and they have no idea whether they have nexus, and they have no idea what the liability is if it exists and how it should be disclosed. And then they come to find out when they get audited, because if they find out they went to Illinois and they made some sales, and because one of their salespeople flew into Chicago once and had a meeting that gave them nexus in Chicago, and now every sale made in that state, and now guess who the state of Illinois is going to go after for the past due sales tax? Not the customers. They're going to come to the company. And so you've got this business with a 25% gross profit margin, and you've got a 7.5% sales tax issue on all your sales in Illinois. Guess what just happened? And you don't even know it. That's this. You've got to know what you don't know. Timely, accurate, and useful reporting. This is basic. This is essential. It's standard. It's expected. You don't get kudos for having this, doing your job. Transparency to support accountability. This is critical. Far too often, and sometimes it happens in our CFOs and controllers' offices, where there is lack of transparency as to how we got the numbers, what they really mean, where they came from. That's not okay. Not acceptable in a finance organization. Complete transparency. If they point to a problem, then we need to be talking about the problem. but we can't hide it. Right? I'm in the office of the CEO. We have a company that is one of the largest franchisors in the country in this particular industry. We're owned by Mutual Benefit Life out of New Jersey. We're talking about the board meeting. CEO says, so Kent, when we make this presentation, I want you to make this as opaque as you possibly can. Interesting. And why would that be, Blaine? Well, you know, these guys don't need to know that. I go, wait. We're talking about one of the board members of Mutual Benefit Life, and if I remember correctly, they invested about $15 million in this company, and our losses last year were $6 million, and they agreed to fund them. I think they have a right to know. We had a difference of opinion on that, and they knew. Anticipate needs. Here's another issue I see far too frequently. The finance department needs to have a service provider attitude. We don't exist if there aren't sales. We're not more important than the sales team. We're not more important than marketing. We're not more important than anyone. We are here to help. Service provider attitude. If we're not service providers, we get fired. That's how it should be. So you should be inculcating that perspective, that attitude in everybody. And I like to say, start thinking like a COO. You've got to go beyond just finance and accounting. That's not what makes the whole thing work. It's the language of business, but it's not what makes it work. You need to know what's going on all over the company. So start thinking like a COO. I had a great, speaking of Skull Candy, Jeremy Andrus and I were at the same time. He was the COO, I was the CFO. And Jeremy did a great job of really understanding, taking that COO focus. He taught me some really important things. The single largest PO that we had ever received was with Target. We had just passed $10 million in revenue. We were on our way to 30. We didn't know it yet. Target had given us a PO, had agreed to buy our product. We were looking and thinking about we might get a $500,000 PO. The first PO was almost $3 million. Everybody in the company is jumping and screaming and shouting. Jeremy and I are going, oh no, we are in trouble. Because I knew we didn't have the money to fund a $3 million PO. Jeremy knew we didn't have the capacity to provide the product. So what did Jeremy do? Jeremy went back to the customer, Target, and said, we love this. We can't tell you how excited we are to have this, but this won't work. You've got orange and camo and bright red and pink and black and white. Your customer won't buy those colors. We'd like you to cut back on the PO, take the basic ones, roll out fewer SKUs, let's see how they sell, and then we'll replace every month instead of doing this 3-month PO. And initially they were a little upset with this. It's like, you don't want, yeah, we want your $3 million PO, but the reality is we can't do it. And the reality is it won't sell. What happened? Everything in Target was sold out in a month. They renewed for another PO. We provided. We could do that much. They renewed for another month, another month. At the end of 6 months, Skull Candies were some of the fastest moving items in Target. And we were a champion. Now think what would happen if Jeremy hadn't looked at that and said, so now here are all the reds, the orange, and the weird colored ones that didn't move in Target. Guess what's going to happen after 6 months? They didn't move. They're sending them back, COD, postage not paid, and you're out because your product isn't moving and it's no good. That's a strategic focus. And you have to give unbiased, thoughtful analysis, and you have to make recommendations. You can never go to the CEO or the board and say, we've got a problem, and then expect them to take care of it. You've got to come. You've got to come with ideas and analysis, and you've got to be ready to say, if we do this, this is what will happen. Okay? I love this one, and this is what you should be looking for. I'll let you read that. I won't read it. This is again from a CEO of a mid-sized rental company, and this is what your CEO should be thinking. I will have someone to collaborate with, not to delegate to. That's a partnership. And that takes trust. And you have to build the trust. This one speaks, this is a CFO of a large consumer foods company, and he talks about creating financial literacy in the organization. What's the purpose of it? When the sales guy goes into the store, he has the tools to understand what the right price points are and what the right package mix is. So remember back in that very first slide, the product pricing analysis? You contribute to that, you participate, you help out, and then you help build the training so that all the sales guys can understand exactly what they're taking in. And now we know when the proposal is made, right? When we make that proposal to do the sale, we already know what the margin is because we helped create it. We don't have to wonder what they're doing. We can also say, well, look, what volume can we afford to bring the margin down? And we know exactly how to go about it because we help to prepare it and understand it and put it together. That adds real value. Now this is one, and this one drives me crazy. Well, it used to drive me crazy. Nothing drives me crazy anymore. But this drives me crazy about, and I'm going to say about the accounting industry and about the attitude of some controllers and CFOs. I call them the chief no officer. Walk in their office and what do they say? No, we can't do that. No. Or, like this one, others in the company should enjoy sitting down and bouncing off the ideas off the CFO, not feel anxiety about going into him or her to request support. Why would someone feel anxiety about coming into your office? Unless you think you're more important than you are, and you act that way. Plain and simple. That CFO should get fired immediately. You cannot be a partner and you won't be effective if you're the chief no officer. It just doesn't work. Nobody wants to be around you and you will not be a partner. Let's talk about the future. CFO's job is to support profitable, planned growth. And you need to understand the cost and availability of capital to your business. I mean, anybody can do a forecast, right? How many hundreds of forecasts have you done in this room collectively? How many of them were right on after 5 years? Has anybody ever had one?
I did one.
You did one? Boy, you're better than I am, because I never did.
Ken, it was shocking, because at the time I was at Eddie Bauer, and we projected this crazy growth, and it exceeded that. We went to 1.6 billion.
Well, I've exceeded it, but I've never been spot on. And even when I've been relatively close, when I look at all of the variables and the assumptions, they weren't even close to what I thought was coming. Any else? Well, that's what forecasts are. Nobody expects them to be perfect, but you need to understand what happens if, and you darn well better know what your cost and availability of capital are. Small, growing startups, even larger businesses, the biggest problem we had at Skullcandy was funding the growth. It wasn't getting the growth, it was funding it, for heaven's sakes. I got Zions Bank. Imagine Zions Bank to give us an overline after we had just finagled our way into a $2.5 million line of credit. They gave us $1 million overline because the PO came from Target. That's what we had to do just to get by, because our growth was so much better than it was than we were expecting it to be. This is another one. If you see, and I used to tell CEOs this all the time, if you see the CFO trying to determine how to allocate capital for investment purposes, you've got a problem. Anybody disagree with that? Not the CFO's job. Where should that be happening?
Sales.
Go up.
CEO.
Board of directors. This process, where are the investments going to go? We make recommendations, but we don't make the decision. That's a board call. But we need to be right in the middle of that discussion, making recommendations and having that discussion. You've also got to overcome and relax constraints. Are they capital constraints? Are they labor constraints? Is it taxation? What is it? What are the issues that are getting in the way? And we need to identify them and then work together as a team to overcome them. Manage risks. We all should have learned a little bit about that over the last 3 years, right? Unexpected things happening. Navigate uncertainties. Challenge the status quo. Anticipate disruption. What happens if our cash flow goes down by 50% overnight? What do we do? How many of you have a 13-week cash flow forecast? I don't care how profitable you are. How many of you do? Good. If you don't, I recommend one for every business in existence. Nothing more important than cash flow, and you need time to respond. When the pandemic hit, what did you do? I wasn't in business. I was enjoying myself. I didn't mind lockdown. That was pretty cool. Because I'd go ride my bike and there were nobody on the street. I could ride everywhere and never have to get hit. But for you, what do we do? The first thing I would look at is my cash flow. Where's it at? What's going to happen? What do we need to do? How are we going to manage this? And then improve predictability with data analysis, metrics, innovation, and automation. I've been talking about automation for years and years and years, but let's be honest, clerks don't have a role in an accounting department anymore. They're dinosaurs. Pretty soon, if not already, the vast majority of a controller's role is gone. It can be automated. It's being automated. So what are you doing? What are you going to do? How are you going to respond to that? You going to ignore it? Are you going to embrace it and see how you make it work? In terms of trust, building trust, I would come into one of our clients and I would interview. Now, remember this, I was the founder of Advanced CFO. I would come in to offer our services. I would be talking to a client because they had called me in most cases. Said, we need your help. It's interesting that I was in there, not their CFO, not their controller, sitting at the CEO's desk. And they're telling me the problems that they've got and the issues that they have concerns about. And so we would talk. And I would say, okay, tell me what's going on. And within 30 minutes, I could pretty well assess exactly what was happening. I've seen it before, many times. Is it cash flow? Is it lack of information? Is it how good the information is? Is it constantly changing on them? What are the things that are happening? So I would ask that question. And then as soon as they would say, yeah, we want to do this, I would go in and I would sit down with the controller or the CFO, whoever that person happened to be. And in many cases, they weren't really excited to have me there. Can you imagine that? That's pretty shocking, isn't it? So I would start talking to them. And within about 10 minutes, I could tell you whether they're going to stay or whether they're going to go. And you know what the number one predictor of whether they're going to go is? They would get defensive and refuse to admit they have problems. What did that tell me? They're not going to listen. They're fearing their job, and they're not going to listen. So I would stop and I would say, hold on, let's reset. I'm here because your CEO called and asked me to come. Just want to make sure. You weren't in that meeting. What does that tell you? I'm not trying to be mean. What does that tell you? Now, I don't want your job. Your CEO could offer me the job all day long. I'm not taking it. I have zero interest. I don't want to bring one of my people in to take your job. I'd like you to stay because you have corporate memory. But this is going to be my way. And you're going to have to listen and you're going to have to agree to go along. I'm either your best friend or I'm your worst enemy. And there's nothing in between. Which do you want it to be? And about 9 times out of 10, they left, or I had them leave. All because they were not humble enough to acknowledge they're making errors. And in most cases, they simply didn't know how to do what needed to be done. And you know what? There's nothing wrong to admit I don't know. I've been in front of Morgan Stanley on Wall Street preparing for an IPO with Mary Meeker. Now, nobody in here knows who Mary Meeker. Anybody remember Mary Meeker? She was the queen of IPOs of technology. Year 2000, 1999 and 2000. Nobody in technology got an IPO without going through Mary Meeker. And Mary Meeker asked me the question, so Kent, I see this forecast. Tell me, what should I be concerned about your forecast? And I said, well, the only thing I know about it, Mary, is it's wrong. I just don't know which way and how far off. And she pushes back. She goes, what the hell? I go, so have your people ever made a forecast that was perfect? I've never done it. He said, here's the key. A forecast we should be able to use to tell us what happens if. That's what a forecast is all about. This one will do that. It won't tell you this isn't what's going to happen. I know that for a fact. She looks back and she goes, you're the first person to ever admit that to me. I said, well, it's the truth. And that's what you should be as a CFO. You should be that person that says, hey, look, I don't know everything, but I'll figure it out. The other thing that would cause me to get rid of someone very quickly was when they would not ask questions, afraid to ask questions. Have anybody do that? What's the concern when somebody won't ask you questions? What's the big number one concern?
Do they get it?
What's that?
Do they get it?
Yes. And they probably don't. And if they don't get it, what are they going to do when they come across the problem? Their best job, which will probably be wrong. And guess what? I don't know about it. And I'm the CFO. I'm responsible. That's a problem. What do you want? You want them to say, hey, I don't get this. Great, that's no problem. I'll teach you. Now, if that happens 3 times on the same thing, you've got a problem, right? But it usually doesn't. But you need someone who is willing and humble enough to acknowledge, I don't know. And when you screw up, what do you need to do? Own it. Plain and simple, own it. This was our mistake. I'm going to fix it. You know, one of the very best companies that I would send people to talk to when they would want to talk to one of our clients was a company where we screwed up royally. We really made a big mistake. But you know what? We fixed it. It cost us $15,000 to fix that mistake and a lot of free time. And that CEO, people would call him and he would say, I would never hire anyone else. They made a major screw up. They found it, they owned it, they fixed it, and they agreed to bring on a competitor if that's what I wanted. And that's how the CFO needs to be. You mess up, you own it. If it means you lose your job, you lose your job, but you do it honorably. But don't hide it. You need to make sure there's accountability at all levels. That includes the CEO. One of the things that we would do whenever we would come into a new client is we would evaluate the people, to have the right people, the processes in place, because processes happen, they're not designed. They need to be fixed. The controls around information and assets, and the culture, and it's a culture of accountability. So if we're going to have procedures and controls, policies, they have to apply to everyone in the company, including the CEO, all the way down. And I need the CEO to be on board with that and back me. If the CEO said no, I refuse the engagement. I'm not interested. And I would always ask the question, what if your top salesperson refuses to follow the policy? What are you going to do? Oh, well, he always does that. It doesn't matter. I said, great. Have a good life. I'm not sticking around. Because if the policy isn't important enough to enforce, it's not going to work. And again, you're the CEO, CFO, you're going to be held accountable. And you're going to have no control. It doesn't work. And you need to be firm, I call it firm, fair, and consistent. I learned this in a collection job I had when I was going to college. If it's not okay for one person not to pay, then it can't be okay for the next person. It's got to be firm, fair, and consistent across the board, and that's how we function. So if you have favorites within the company, don't treat them any differently than the guy you dislike the most. It's got to be fair. Otherwise, you don't have trust. We've already talked about this. No always has explanations and suggestions. No can never be, that's the answer and there's nothing else, unless it has to do with something illegal or unethical. Then no is no, and that's good enough. And it's also important with outside stakeholders. So I've done a few turnarounds over the course of my career. And do you know, when we do a turnaround, the reason that I'm there is because the prior CFO was not honest. And the creditors found out, and he was gone, or she was gone. And they brought in somebody. What I've learned in doing turnarounds, and it's the same with everything else, is people don't mind getting bad news, but they don't want to be surprised. And they don't want to be lied to. That's the same with your outside stakeholders. 2017, January 2017, I'm asked to come and join a company to help organize a turnaround of this business, if that can be done. We go in the end of January and meet with the bank, and we bring and we lay everything out for the bank. The whole picture in complete transparency, and the company is in violation of almost every bank covenant that they have, and there's $32 million of debt. We get through with the meeting, and there are some eyebrows, there's some very concerned looks. I'm watching with the bank, and it's got the president of the bank and the chief credit officer, and everybody's there. And we lay it out for them. They talk and they say, "Well, we need to get this is a lot of this is new information from us. So we need to chew on this for a while." We finish. We excuse ourselves. As I'm going out the door, the CFO of the bank and I worked together at one point in time, and I know the president. They pulled me aside with one of our other members and said, "Come here, we need to talk to you. Go down and sit in the office." Here's what they said. "You provided more information in this meeting than we have had in the last year and a half from this company. Because we know you, we believe it's true. And because we trust you, we're going to hold you to the fact that it's true. Had you not walked into this bank today with this discussion, with this transparency, and with everything we've asked for, the company would have been closed within 3 months. And they have every right to do it. Every right. And the reason why it would have been closed was because they did not have honesty and transparency from the previous management team. Today, the company has a 30% EBITDA margin, between $50 and $100 million of revenue, and they're doing very well, thank you. And they have $3.5 million of total debt. That could have been gone simply because, well, this is one of the key things. Poor management is the other one, right? That goes to be said. I'm just making a point that really bad situations can be handled and managed if you are honest. I've never had a bank call a loan or foreclose when I gave them advance warning that we have bad news coming. Never. They don't like it, but what they don't really like is not to get the information until 3 months after it's due, and then they find out the covenants are broken and you don't have a story. They'll call those loans. This is a good one. You should read this one. And I think they'll send out these slides if you want, so you don't have to take pictures or copy them down. I'm okay if they do. I don't care if you compete with me. You should read this one. You should memorize this one. Because this defines how it works. Hold the CEO accountable. Every good CEO understands that accountability should exist for everyone in the company, including him or her. Regarding strategic matters, the CFO is responsible to the board, not to the CEO, to the board. On a day-to-day basis, he or she is responsible to the CEO. A CFO that doesn't stand up to the CEO has no place being the senior finance executive in the company. It's a tough position. Your job's on the line. That's why I liked my business. It's just one client. If they fire me, okay, go find another one. But you should remember this little piece in red right here. A lot of CFOs do not understand this. You are responsible to the board for matters of strategy. And that's where you should be talking. Now, let's talk about board advisors. You, as a CFO, have a fiduciary responsibility to every shareholder. Is that the case for all board members? Does every board member have a fiduciary responsibility to every shareholder? What if I am the Series A shareholder representative? Where's my primary responsibility? Series A shareholders, they elected me. They are my first responsibility. Do you recognize that? They won't always make decisions or make recommendations that are beneficial to all board members because they have a specific responsibility, a specific fiduciary responsibility to those shareholders who voted them in. And sometimes we don't understand this. And we look around the table and we think, what's wrong with this guy? He's always pushing. Who does he represent? Oh, well, then it makes sense. Now, is it okay for someone to call him on the table? Yes. Balance. You, the CEO, and any other general shareholders elected by the common have a fiduciary responsibility at all. You need to know each board member, who they represent, what they need, and what they want to see. This was always something I always did. I would go in, I would meet the board members, I would talk to them. What is it you like to see? They all like to see different things. So we would almost have a different set of reporting for all of them. One of the things I used to really like to do, and I found it really, really helpful, is when we put together the board package, we would make it very short, very concise, very clear. And then I would have a slide, and behind this slide were all the details. Because there were always 2 or 3 board members who would call me up and ask me all kinds of questions. Lay them out. Just say, go back to the auxiliary material. There it is. You can look at it. Go for it. But keep it short and simple because that's what most board members want. But find out what they need. Provide the whole story with whatever you're doing. When you're reporting to the board, tell them the whole story, good, bad, and indifferent. They need to know that, regardless of what your CEO says. Champion ethics throughout the organization, even in the boardroom, because they were not always there. And somebody needs to do that. You also need, in today's world, you need to be measuring your company's sustainability and social responsibility. If you don't, somebody will, and when they do, it won't be positive. So you should be thinking about this. And finally, somebody's got to call out the elephants in the room. So when that board member, the Series A board member, is constantly pushing for what he wants for his shareholders, and he's doing it to the detriment of the other shareholders, what do you need to do? Somebody needs to call him out. Say, hold on, Jim, come on. That's not good for the company. Let's talk about this. Let's talk about the message we're sending here. Let's talk about, I mean, obviously you have to be careful. He doesn't report to you, but it's okay for you to question, to challenge, and then again, try to provide alternatives for that. Instead of doing that, what if we do this? Wouldn't that make more sense? But somebody has to do this. And I've just never seen the CEO as the guy that will do this. Not even sure I know why, but I rarely saw that. I found that the CFO, we did this a lot in board meetings. Any questions or comments? Been really quiet. That means you're either bored and asleep or anything? No?
Ken, I was going to make a comment, but I've been doing this a long time, like you. The CEO's afraid of his job. That's why he doesn't want to talk about it, because the board can fire him like that.
You can fire the CFO too.
Yeah, oh yeah, I've been there.
Yeah.
The slightest little things that the board don't like.
Yeah. And that's probably really true. They too much to lose. That's the end of my slides. I've got 13 minutes here. Anything else you want to talk about? Yes.
I'm a controller, but since the CFOs don't have any questions, I'd love to know what can I do to help my boss out more. You mentioned a lot of great stuff that said CFOs shouldn't be doing this. I wrote those down. But yeah, anything else, maybe so you can help them shove more work onto people like me.
Well, one of the things that controllers should be doing that I don't see a lot of controllers doing is looking for ways to improve the productivity of their team. I'm thinking specifically automation. How can you bring automation into your organization? How can you better integrate all of your systems together so that there isn't double entry of anything? How can you get rid of spreadsheets? By the way, I hate spreadsheets. I despise them. There's no audit trail. The most recent survey I looked at, 40-some-odd% of all spreadsheets have fatal errors and nobody knows about them. Do not use spreadsheets as any kind of tool other than for analysis and reporting. It's not worth it. I don't think Jeremy would mind this, but when Jeremy got into Traeger grills, he called me up one day and he said, I need help, but you can't tell anybody what you're doing. And I go, that's okay, that's interesting. We bought this company, Traeger. They're up in Portland, Oregon. I've got a finance team. It's a really, really big team, and I can't get information. I have no idea what's going on. The company was a bit over $100 million. He said, would you fly up? You're just an advisor to me. Just fly up and check it out. I said, sure. Fly up to Oregon. I go and meet, and I start meeting with the CFO. Is a really nice guy, smart guy. I meet with the controller. I meet with 2 or 3 other people. And after a day and a half, I stopped counting at 200 individual spreadsheets being used for transaction processing. Amazing. I was blown away. And I said, I just don't understand. I mean, this wasn't 2020, but it wasn't 1973 either. We do have computers. We do have software. We have good software. You're a profitable $100 million company. What's going on? Then I find out that the founder of Traeger refused to pay for software, but he would let them hire people. Well, that's brilliant. $100 million company, 50 plus members of the accounting team. 50 people. He was paying for the software 7 times a year. So I came back and I said, well, you want the good news or he said, do you want the bad news or the really bad news? I said, the first thing is I have no idea, I have no clue how they get a clean audit opinion. I can't imagine. You should have tried that one. I can't imagine how they do, because everything is on spreadsheets, and those spreadsheets are just on individual computers. All of the buying, all of the inventory. I don't know how they did that. So anyway, make a long story short, it took a complete revamp of the whole program, and the company, that part of the business almost collapsed under its own weight before we got the new software systems in and everything integrated. It was very expensive and a very long process. So that's the extreme end of spreadsheets, but even most organizations have something, whether it's a depreciation schedule in the fixed assets or something that they're doing on just spreadsheets. And I keep asking the question, why? Why are we doing that today? We don't need to do that today. These should be fully integrated systems. Let the customer, let the vendor, let the people do all the input for you. It's out there. The portals are available. Let them do the input. Use your people and their brains to think and stop doing clerical work. So that's one thing I would tell you to do as a controller. The second thing I think a really good controller needs to be is it needs to let the CFO know where he's blind. You know the details. The controller knows the details better than the CFO does. Let him know what he's missing, where there are problems, where there are issues, where you need support to get things done. Funding, technology, whatever it happens to be. Again, in the same way that the CFO should be working with the CEO and the other C-suite members as partners, you need to work with your CFO in the same way. Have that same relationship where you're collaborating together, not just being delegated things to do. And the sooner you can start seeing things strategically and understand, the more benefit you'll be able to help him and point out what he's missing. Yes?
Could I just add to that, don't always wait to have something delegated to you. With me, I know that, all throughout my career, people willing to come and say, hey, I can tell that you're busy. Is there something I can help with whatever you're busy with? Or is there something I can help take off your plate? And just them willing to ask added another level of trust. So don't always wait to be delegated. Instead, show where you have availability. But also, like you said, I completely agree, being able to show, hey, here's what I'm blind to. Here's what I don't know.
Yeah, good. I agree. That's good.
Ken, got a question for you.
Yes.
Maybe you already addressed this in your presentation, but you kind of parachuted in, it sounds like, in that advanced CFO space into an existing team. You're the new player in town. How do you develop that trust with the team, right? I mean, where they don't think that you're just trying to show them up or be critical of everything they've done, right? They've got a lot of pride in what they've built, what they've accomplished, and if you suggest something different or a different way of doing things, they think you're being critical of them individually as opposed to just helping the team out. How do you build that up without, to your point of maybe having to get rid of some team members?
If there are people who really want to learn, if they want to stay, again, my goal, my preference was always keep the people because they've got memory. They know what's going on. But it was always the first thing I did. Do we have the right people in the right place, and do they know what they're doing? Do they understand, or can they be trained? There are, quite frankly, some people who aren't going to ever make it. I don't mean to be crude or rude, but I decided really early on I can't fix stupid. I can't. Someone who simply is incompetent, unable to learn and understand, I can't fix it. I don't care how long you try. So it's just time to say goodbye. But the way you handle that, Morgan, makes all the difference in the world, right? Don't do it in front of everybody else. Have individual interviews, talk to them, see what they want. 9 times out of 10, when I would have the conversation, they're miserable. They know they're not doing well. They don't know what to do. They're frustrated. Maybe they've just never been trained. Great, let's train you. Maybe they were put in that position, but they don't want to be there and they don't know and they've never had the experience, and I don't have time to teach someone how to do that. So let's find you another job, either in the company or I've got contacts, let me help you. Let's find someplace for you to land. And I think when you treat people with respect and kindness, and when you're honest, even sometimes brutally honest, but you do it in the right way, you can develop trust really quickly. And so look through the organization, find everything that's going on, get people to help you and volunteer and jump in, which they want to do, if they want to stay, if they want to learn. I had many people say, this is exciting, this is fun, nobody's ever asked me these questions before. I'm learning things that I never knew before. Nobody ever talked to me about it, right? Controller just kept everything in his office, he closed the doors, he put down the shades, you'd make a request and he would slide a piece of paper under the door and there you got. No answers, no questions, just here you go. And so we change it to a very transparent, open organization. You can ask any question you want, nothing's dumb, no one will be judged, and let's get the job done. It's a lot like I would do when I would be in a sales meeting with the CEO. I would paint the picture of what things can be like before I would have any conversation about what we're going to do. What if your financial statements look like this? What if we were providing this information? What if every week we had a dashboard for you? What if? I would paint the picture, and then when I got them sold on the picture, then we would talk about how we're going to build that up and make it work. And people would get excited with the vision of where we're going. And then when they see you actually deliver, that's where the trust comes. And when they see that they can come to you and ask questions and admit they don't know, and there are no consequences, no negative consequences, that's when the trust comes. It takes time, but you can do it pretty quickly. At least that's my experience. Yes?
I've heard several times today, it sounds like kind of the standard for cash flow forecasting is 13 weeks. We do 12 months, a rolling 12 months. Is that insane?
No. It's just in my experience, if you go, it's interesting. Does anybody know where 13 weeks cash flow forecasting comes from? It's bankruptcy. It's turnarounds, restructuring. It's one of the things that the bankruptcy court demands, 13 weeks cash flow forecast. But it turns out that 13 weeks is a really nice period of time where you've got a lot of visibility to what's going on and you can do a pretty darn good job of knowing where you're going to be. And sometimes you have to move this week to here and this collection over there and back and forth, but that's okay. You can see it and you can see the ramifications quickly if something happens and what's going to go on. So mine was always a rolling 13 weeks. So you always add a week on, always add another week on. We always had a budget, an annual forecast that would have cash flow in it. Rarely did it by weeks, usually did that one by month, but it depends. Your business may require that, and if it does, go for it. It's just my experience was harder to get it right 9 months out as much as it was 3 months. Well, I think we're close enough to the end. Thank you for coming. It's been a pleasure to be with you. Good luck.